Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we're going to be looking at the definition of tax expense, or also known as a line item on the income statement called tax expense. As we do in each one of these fundamental analysis tutorial videos, I'll give you the actual definition, then we'll go on to look at some examples and give you a little more insight. A tax expense is a liability owed to a government. That's it. It doesn't matter whether it's federal, state, provincial, municipal. Tax expenses are calculated by multiplying the appropriate tax rate of a business by their reported income before tax, after factoring in such variables as non-deductible items, tax assets, and tax liabilities. Now let's look at some examples. Okay, the first question you may have is, where do I find this actual tax expense listed? You'll find it on the income statement. I'm looking at McDonald's Corporation. I'm on the Yahoo Finance page. Again, looking at the income statement. You can find this information anywhere. Discount Broker will have the information available to you. You can find it within the annual report of your any company that you're looking at investing into. But the thing I want to draw your attention to here is that this is an excellent tool for spotting a red flag, if you will. Benjamin Graham, in Warren Buffett's teacher, when he wrote about this, and I believe it was, whose book was it? I believe it was The Intelligent Investor. He said that, you know, it amazed him whenever people would report a positive income. You know, they would have operating income of X amount, and then they had the income before taxes would be a positive number. But then sometimes you would find income tax expense would be a negative number, and that was an easy way to spot whenever management may have been juicing their reports, making it look better than it really was. Because you think about it, if a company actually made real revenue, real money, they would have to pay an income tax on that. And if you have a situation where you have billions of dollars of reported income and yet you're not paying any income tax, that you're probably juicing the numbers somewhere. In this particular example, we don't see that. I'll show you an example of that in a minute, but that's just one of those red flags that I want you to pay attention to. What you want to keep in mind is right now, currently in the U.S., it's the tax rate is going to be approximately 35%. So if you take this number here and compare it to this income before taxes, and you don't come up with approximately 35%, there should be, you know, some questions being asked. Now, it's not going to be exact. I mean, there's not it's not as simple as that. There's obviously, you know, certain things that are deducted and non-deductible items and things, different variables that go into it. But if it's not close to it, then there should be some concern there. And if it's an obvious, blatant, ridiculous number, such as in this case, if this was $8 billion of income before taxes, and then down here you see a income tax expense of negative $3 billion, there's obviously a problem there. Okay, now we're looking at the Bank of America income statement, annual data. Scroll on down here, look for the same information. Alright, got the tools again. We can see there's not all filled out here, but if we did the math, we would find that earnings before interest and taxes was $18.3 billion. Interest expense was $16.4, and they get left with income before tax of a negative $230 million. Their income tax expense was a negative $1.6 billion. This makes a lot more sense here. They basically are saying at the income before tax line that we didn't have any profit. We actually had a loss. At this point, they're showing that. And that's something else to keep in mind. Whenever you have a situation like this where you're showing a negative number, then if you get an income tax expense, it's a negative number. That would make sense as well. That's fine. That's perfectly understandable. You didn't make any money. You wrote off some things, and you had your non-deductible items, tax assets, tax liabilities, so forth and so on. And you've gone through this process and you've come to the negative number. That's telling the truth. You did that by a simple, understandable means. And let's look at one more example. Okay, now we're looking at the General Motors Company. You can see that we're looking at, again, the income tax statement. The income statement, and you're looking at the annual data. You scroll on down here. This is the reported period for December 30th, 2011. Scroll on down a little bit further. Move that, like that. Okay, got the tools. Income before tax, you're seeing a $5.9 billion. The income tax expense, negative $110 million. If this was real income that was actually earned by the business itself producing this income that was legitimate, you would have to pay taxes on that. When you don't have to pay taxes on money that you've earned, you didn't earn the money. That's just the basic rule of thumb there. Now you could dig into it and there may be some amazing miracle way that this actually works out, but this should definitely be a red flag for you to, if nothing else, tell you to dig into the numbers and figure out what the heck's going on here. Okay? And now you know. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.